Look at the physical reality of the Indian economy right now. We are seeing a broad-based structural shift in domestic manufacturing and R&D. Significant government spending is pushing capital into local production, creating a concentrated influx of funds for aerospace and military manufacturers. Simultaneously, the national railway network is undergoing an aggressive modernization, locking in multi-year contracts for safety systems and infrastructure upgrades. It extends to high-end technology, with Indian firms securing critical roles in global aerospace and satellite projects. This physical growth is reflected in the stock market. Companies in these sectors are shattering previous records and reaching new all-time highs every week. These peak valuations reflect a market that is pricing in a multi-decade industrial expansion. But looking at these peak charts creates a psychological trap. You feel a paralyzing fear of buying at the absolute top, constantly fighting against the fear of missing out on further gains. You're staring at a split reality. On one side, you have strong financial metrics and expanding backlogs. On the other side, the valuations look stretched. History shows that buying a stock at an all-time high isn't inherently dangerous. The risk comes from participating in the market without defining your exact time horizon. To navigate this, you have to view these stocks through one of two distinct lenses: short-term momentum or long-term fundamentals. Both traders and investors are operating in the same environment, a significant volume of institutional capital flowing into the system. This flow is driven by aggressive domestic spending and global supply chains shifting production toward India. This capital creates a premium. The market has already priced in years of future success for these companies. Because these prices are stretched, there is no margin for error. Any delay in execution or missed target will trigger an immediate price drop. Now, let's look at the first approach, the momentum play. This strategy targets high-velocity electronics and tech stocks like Syrma SGS and Netweb technologies. Here, you ignore the 10-year outlook. Your input is immediate catalysts, like a sudden earnings surprise or a fresh government announcement. The outcome you want is a sharp price appreciation over a tight 1 to 3 month window while the sector remains active. The trade-off is non-negotiable. This requires intensive daily monitoring and the ruthless execution of stop losses. Normal market volatility can cause very sharp pullbacks, shaking out weak positions before the stock continues its trend. The momentum strategy is an active, demanding job. If you treat it like a passive hobby, it won't work. The second approach is the fund manager view, the fundamental play. You stop looking for quick catalysts and start demanding a clear visibility of earnings. This chart compares Azad Engineering's current valuation against its substantial multi-year backlog. A guaranteed order book like this changes the core risk profile of the investment. The same logic applies to companies like Kernex Microsystems. Their role in the National Kavach railway safety system creates a near monopoly that protects future revenue. The intended outcome here is multi-year wealth generation tied directly to structural shifts in the country. The trade-off is that you have to lock up your capital and endure the 20 to 30% cyclical drawdowns that inevitably occur along the way. Fundamental investing in this market means paying a premium today for the psychological safety of a guaranteed revenue pipeline tomorrow. So, how do you decide? Can you monitor the market daily? If you have time and honor strict stop losses, Route A is your path. If you have no time but can stomach a 30% drop, choose Route B. Otherwise, stick to index funds. Losses in a bull market happen when you ignore your constraints. Choosing a strategy your daily schedule or nerves simply can't support. That brings us to the single most destructive mistake you can make in a high valuation environment. It's becoming the accidental investor. You buy a stock for a quick short-term flip, watch the price drop below your target, and then lie to yourself that you are holding it for the long term just to avoid realizing a loss. An all-time high is just a number. To navigate it successfully, you must declare your timeline before you buy and refuse to change your own rules